Welcome to the EXP Group's discussion of ACCA paper P5, Advanced Performance Management. Last time we were talking about financial performance measurements that are typical at companies. Today we wish to look at financial performance measures which focus on different levels within a company, and we're going to use the divisional level as our focal point to understand in what ways the performance measurements which are applied at the divisional level may conflict or be inconsistent with the interests of the company as a whole. Let's start with the return on investment measure. Now, this is a measurement which relates profit with the amount of resources that are being invested. So it's a percentage measurement, and it's something which can be applied both at the corporate level for the company as a whole, return on investment, or the term is also used return on capital employed, or the ROCE can be used at the divisional level, and if the division is considering individual investment projects, they would usually think in terms of investment amount and the return generated on that, i.e. return on investment. So it's broadly the same concept, we just have to make sure we define our terms properly. Now, here's the crunch. Let's take a situation where we have a division that has achieving an actual ROI of 20%. Now, if that division is approached with a new project which offers only 15% ROI, and the division's performance is based on actual ROI achieved, then the division is likely to reject this newcomer because the 15% ROI will bring down their average return on investment achieved. Therefore, we would have a reject decision, which would be quite logical from the point of view of the division. If we broaden our view to the company as a whole, however, and we say that the company's overall cost of capital is 12%, and therefore any project which beats 12% is actually an acceptable project for the company as a whole, then we will be in the curious position of actually having rejected a project at the division level which would have been a good project for the company as a whole. This inconsistent outcome is an example of dysfunctional behavior and dysfunctional, inconsistent performance measurements within the company. The parts don't fit together properly or in a coherent or logical way so that the actions of the divisions are advancing the overall interests of the company as a whole. Now, one way of getting around this, some companies have refined their metric to embrace the residual income method. And the residual income method does the following. It looks at a project in terms of the residual income that's going to be generated, and if the residual income is positive, then the project should be accepted. How do we compute residual income? Well, the residual income is derived from calculating the profitability that is generated at the divisional level minus the cost of the capital resources which are used or employed by that division. Now, the cost here, this imputed interest, can also be understood as a charge over capital cost, if you will, or an opportunity cost of the capital resources that are invested or employed at the divisional level. So we would need to know what the dollar amount of capital is that's employed at the division, and we would need to multiply that by a capital charge or a cost of capital. If we looked at the previous example, where a new project is offered at a 15% return on investment, we would be saying as follows. Suppose it required $10 million investment, and therefore the return on investment would be $1.5 million. Let's take this $1.5 million as representing the EBIT, which would result from the investment. Now, by investing and tying up $10 million of capital, this would give us a capital charge, which would cost the company overall 12%. We said this was the cost of capital for the company as a whole, which means that the imputed interest on 10 million being the capital employed, being multiplied by 12% would be 1.2 million. If we deduct 1.2 million from 1.5 million, which is the divisional EBIT, we will end up with 0.3 million positive residual income. And therefore, this project should be acceptable from the company's point of view overall, and therefore the division should accept this project, but of course that will only work if the division's performance is going to be evaluated on the basis of residual income and not on return on investment achieved. Now, having introduced those two methods, let's just look at some drawbacks as well. Here's some data regarding a 12% ROI project. Requires an investment of 4.5 million. Now, the corporation currently generates 12% ROI. The cost of capital for the company, and this is the relevant benchmark for the purpose of calculating the imputed interest, is 10%. Now let's look at the impact over several years of this project, making the ROI and RI computations. One can see here the 4.5 million initially invested. Now this amount will decline via a straight line depreciation method. We can see here the depreciation is in each year is 1,125,000. If the cash inflows, we'll take this as a proxy for a profit figure, 1.5 million, has depreciation deducted from it, then we have a post-depreciation profit of 375,000 in each year. Now, for the purpose of calculating the residual income, let's apply the capital charge. Let's calculate the imputed interest on that. 4.5 million means we have a capital charge of 450,000. That's at 10%. Now the capital charge will decline each year because the net book value of our investment is declining. Therefore, we can see as a result that the residual income of the company, the residual income calculation, will go up over the 4 years. The return on investment, we can see, also is distorted by the accounting values that enter into the picture. As our net book value declines from year to year, our return on investment is going to increase as well. So both the return on investment and residual income calculations suffer from the fact that they are based on financial accounting data. And we can see in both cases here that the indicators rise over time, and in fact in the first year both the residual income and the ROI look deficient, which presents the additional problem of or risk that a good project or a project that would turn out well over several years may look unacceptable as viewed according to these computations for the first year, and therefore may be rejected. Which brings us to another metric which has been implemented to get around the drawbacks of residual income and return on investment, and that is called the economic value added method. Now, it bears a similar it has a resemblance to the residual income because EVA, the economic value added, consists of deriving something called net operating profit after tax, kind of cash-based operating number, a profitability number, and deducting from that a capital charge based on the amount of capital which is tied up in the units being whose performance is being measured. And this capital charge is going to be determined by calculating the capital employed by R, and the R is typically the weighted average cost of capital to the company. Now, the difference between EVA and the residual income is that EVA does not use financial accounting measures, or better said, it refines the data which goes into the EVA computation. It extracts from the financial statements the data necessary to be able to build the EVA calculation. But it does so in the following way. There are adjustments which have to be made to the financial statements. The adjustments are going to be made so that we have a proper capital employed figure, not one which is taken purely from the balance sheet, and the net operating profit after taxes, the NOPAT figure. The capital employed figure proceeds on the basis that we have to add back a number of things which will have been deducted from the balance sheet due to accounting rules. Things such as operating leases, goodwill, intangibles, and provisions for bad debts. So typically things which have to be written off in full, research and development being another good example as part of the intangibles. These are all considered to be economic investments that the company's been made, and they should count in among the capital employed. Similarly, we have to go to the income statement and we have to make adjustments to the so-called distortions to the profitability figure in order to come up with a cash operating profit number. This means adding back accounting depreciation and goodwill and any other provisions and non-cash expenses which may have diminished profits, so that we end up with a number which is, as we can only characterize it as being basically a cash-based operating profit number. That's what the NOPAT is. And in doing so, the goal here is to determine over a period of time whether a company is actually creating economic value or destroying economic value based on its operations. We leave the following example or illustration to the candidate to understand, based on numerical data here, how the EVA calculations and the adjustments are performed in the context of a typical exam situation. Thank you.